we're almost always blind to all the connections on the way up. But some things have happened in China recently which bear watching. Late last year, there was, it seems, a lack of eligible collateral. So banks were taking commodities as pledged collateral for loans. So this is the first time now that that was happening. Again, it suggests, A, that there's not much viable collateral in China, and secondly, if banks are willing to take such a volatile asset as collateral, how desperate are they to lend? This really seems like the end of the lending cycle. And of course, when that was made allowable, commodities came out of the woodwork. So there's an additional problem. For the last decade, China's probably been stockpiling commodities because they didn't trust the dollar either, or necessarily the euro. So the stockpiling of commodities probably means that as China slows, they have to work off those excess inventories, and it may take years, and I'm guessing probably decades. China's at a very similar position to where we were in the 1920s. But with less transparent and open institutions. So it's sometimes hard to know what's going on, but the wheels of credit are grinding to a halt. Industrial production in China is down about 10% so far this year, it seems. The statistics are very unreliable, though. But again, we see it most in commodity prices. I think the impact of a hard landing in China is mostly psychological. Because every bullish argument we see about how we're going to muddle through or get through this, it's the developed world riding on China's coattails. The Asian miracle will continue. And somehow China is going to expand and pull us all up through this until such a time that China slows down and hands the baton back to the recovered West. Seems like a fairy tale for frightened children. But can you imagine this Chinese hard landing happening right now as Europe's yet unresolved? Well, that's it, right? We have at least the semblance of a free market system. The Fed's been giving the banks currency. I want to be careful. I would say money, but it's not really money because money flows through the economy and is spent. The currency that the Fed's been giving the banks as reserves has stayed really on the Fed's balance sheet. Now, a lot of it has been through repos and swaps, traded out and found its way into various assets, junk bonds, and the stock market, etc. But it's up to the banks to make the lending decision in the U.S. So the Fed's given them reserves, which is the raw material of credit. They have to go out and lend it. There's no demand, really, but also they're not lending. In China, the government says, here's 17 trillion renminbi, and that's your quota for the year, and you will lend it. And guess what? It's all out the door by August. So you can sandbag, meet your quota, relax for the last quarter of the year. It's a legacy of the old communist planning. You see it everywhere in the economy. I used to think when I looked at the Chinese economy that, my God, they're going into the deepest depression every September. No, it was the old quota system at work. Everybody did their work and met their contracts. But in China, yes, if you don't honor the comrades' wishes, you're not going to be a bank officer for much longer. So the money keeps getting lent. And it's not dissimilar to how it happened in Japan either. Well, you know, from Sino Forest to all the accounting fraud that was uncovered last year, and when they got John Paulson's fund in, John Paulson was a very successful, still is alive, he's not dead yet, successful hedge fund manager who got caught owning some Chinese shares, and he's supposedly brilliant, and there was accounting fraud. They were cooking the books. If a big guy like him who's so successful could miss it, Yeah, everyone's sort of avoiding the Chinese companies, Chinese listed companies, and certainly IPOs and things. It's a global problem. It's not just China's problem now. You know, I'm here impugning the Fed, and I'm thinking, 10 years ago, we had a lot less company. The reputation of the Fed has sunken and central banks generally, central banking and even modern economic thinking is kind of embroiled in this. But similarly, people have pulled $5.4 billion out of equity mutual funds in the US. The latest data is 2 weeks old. So they're pulling money out. Institutions are still trading, so you see the stock market averages, I guess, giving us an all-clear signal. But similarly, there's a heightened level of distrust here in the US too about listed companies. China can fix it. I laugh because I do read a lot of economic history. And back 100 years ago, there were 4 highly touted investment ideas, basically themes. One was to invest in the fast emerging US market. The other emerging market was Russia. The third was Argentina. And if you wanted to play it safe, you leave your money in Great Britain. I remember reading all of these investment outlook, portfolio recommendations. And if you think about it 100 years later, not that you would ever have to hold those positions, only one idea really worked out over the century, right? But the British were scared to invest in America because the financial disclosure was specious. We had Drew, we had Gould, we had Vanderbilt, we had market manipulation like you wouldn't believe. And we recovered. We got Gap. For what it's worth. We got banking reform in the 30s as a result of an egregious mistake and credit explosion. But it'll happen over time, I guess, if the Chinese authorities are serious about clean and clear financial disclosure. And it became clear, I think, through the 30s, especially with the Investment Company Act, 1940, that America was very serious about rooting out all the double and triple dealing that happened in Wall Street in the 20s, especially. I actually think the Greek exits would most likely author further exits from the Eurozone. Right now, they like being members of the Eurozone. But if Greece left and got the drachma back and devalued, lowered their price level. Now, I don't agree with these mechanisms of modern central banking, but this would improve their standard of living. They don't have the debt anymore. They're out for 30 cents, at least. They probably repudiate all of it. And then the rest of Europe would be watching the Greeks and saying, they're not doing so bad. If we look at Denmark, what economies are growing around the world? We mentioned Brazil. Any others come to mind? Argentina, another grain producer.
They went out 10, 12 years ago.
Right? Russia, right? Denmark, Latvia, Lithuania. Estonia is not, but they're in the mix. Iceland. Yeah, do you know that there's a common theme among these countries that are growing, especially the small ones? Iceland.
Well, because they're growing from zero.
Right. Starting from a penny, it's easy to double, I know. Iceland, no bank bailout. Denmark, no bank bailout. Lithuania, Latvia, no bank bailouts. A deep crisis, but Iceland was out in 18 months at 40% the previous price level. And now they're growing at 3-point-something% a year. Their crisis ended in 18 months. Our crisis ended in 1920 in 18 months. And industrial production came roaring back. That's why it was the roaring 20s. We let the markets clear. I don't know how you avoid the iron rule of economics. Prices have to find their right level. And if wages are at 1998 levels, what level of debt can we support in our society? I don't know. Maybe it's not quite 1998 levels because interest rates are lower than they were then. You can service more debt. But it's certainly not the 2006, 2007 levels. We know that. That's where the wheels fell off the cart. Now we're still trying to rationalize it. But I believe we have another $10 trillion of debt to write down globally or so. About half of that here in the U.S. before we come out of this, or we'd be in a better position to start seeing consistent growth that we've been used to. Well, I'll say a couple of things. The world's absurd. So before we have a hyperinflationary moment, we're going to have a deflationary moment, right? Because we are still carrying too much debt we can't service. And the cure for too much debt is not more debt. I don't care if it's in the Stability Fund or the Greek government or the European Central Bank or whatever. Ultimately, the workers of the world, and especially the developed world, can't support the levels of debt we have now. So what happens, though, when all that debt that's denominated in dollars is wiped out? The remaining dollars are worth more, right? I couldn't disagree with that more. Previous deleveraging cycles, I have seen interest rates bottom and stay flat, saucer-shaped. They will eventually rise, but the level of activity, interest rates are a price signal, of course, the cost of capital, cost of money. In an economy that's overbuilt or oversupplied with labor, in China, oversupplied with houses. We're oversupplied with houses, though there's good news there too, because the household formation rate just finally exceeded new construction, so maybe we'll start to absorb, though very slowly, some of the excess inventories we have. That's a good sign, though. Again, things are progressing just too slowly. But to your point, interest rates bottomed in 1946 at 2.06% in March on the 30-year. In 1956, after 10 years of industrial production growth at over 12% and an average growth in the of GNP at that time of over 6%, guess where interest rates were? 2.26. A whole 20 basis points higher in 1956. And in fact, because the economy expanded so rapidly, government debt levels went from 115% of GDP down to 52% of GDP. So therein lies possibly our way out. Each time we've had a deleveraging cycle, once the deleveraging is complete, the economy expands like a coiled spring with very low inflation because there's still slack we're taking up. I mean, this went on for the U.S. really from the roaring 20s. Some of you in here have heard me mention this before, but you know when the last hotel was built in downtown Manhattan in the 20s, it was the Waldorf Astoria Hotel. Ground was broken in 1926. It was finished in 28. They went bankrupt in 1932. How long was it before another hotel was built in downtown Manhattan? 1964. This is the U.S. Did we grow rapidly in the 50s?
Yeah.
We even grew it during the war years. But we couldn't absorb that capacity. The Empty State Building, or Empire State Building, it was jokingly called the Empty State Building, not more than 50% occupied until 1953. Not another new skyscraper in downtown Manhattan until 1969. That one's gone, right? The Empire State Building was started in 1928, finished in 1932. So we had our own challenges with overbuilding and then growing into that capacity. And I'm saying this is true of the whole world. The problem of central banks pumping up monetary reserves in this monetary inflation, the problem. The joy, the way they like it, is it brings future consumption forward. Oh, we'll buy it today and pay for it over time. At these low interest rates, the Fed keeps pumping in, or the central banks of the world keep pumping in new credit. But I will say, Joel, to your point, he asked if then the appropriate model is interest rates bottom and stay flat for a while before they rise. And yes, we think that's a more accurate model. In a lot of ways, that's what gives us some confidence, because we do not expect any inflationary spike, y'all. That means your bonds are safe. So, might they do nothing and stay flat? Yes.
It provides opportunity.
Would they fall in value greatly? Probably not. And we think the risk reward is really in favor of them rising and interest rates falling further. That's what we believe, yes. Thank you for joining us for this video presentation and for your interest in Haydel, Biel & Associates. We hope you'll feel free to contact us.